This is our second episode of Fireside Chat, and we're going to be talking about a very interesting portfolio concept known as the 60/40 portfolio. This was the gateway into multi-asset investing because the idea was to have 60% of your investments in stocks and 40% in bonds. This would ensure that no matter what the market climate was like, you would make some returns and you would be able to withstand some level of volatility. After all, bonds would perform in years that equities could not, that is typically in recessionary environments or when earnings growth was a little subdued, and equity being the best compounding asset class with the longest history of nearly 200 years would give you that extra bit of returns to tide you through. This strategy worked successfully for nearly 40 years in advanced economies, and it finally broke down in 2022. So we're going to look at what the 60/40 portfolio tried to achieve and whether it's still relevant to investors today, and if it's not, what they should be looking at in terms of multi-asset investing. Let's break down the success of the 60/40 portfolio. If we rewind time to about 40 years ago, where in the 1980s, the US had come out of a period of very volatile inflation, and then you had interest rates pretty much trend downward for the next 4 decades, right? Of course, you had mini cycles in between, but essentially what was happening was you had a period of low inflation, low interest rates, and you had liquidity increase continuously through this period, primarily fueled by bubbles and central bank actions. In this environment, of course, bonds did well for a while, primarily because they made a lot of mark-to-market returns. You also had stocks doing really well because there was more money that was moving into risk assets, and you had lower cost of borrowing, you had lower inflation. So, of course, in terms of profitability and margins, that was really good for businesses. But now, because the macro environment is changing and we've entered into a period where you have higher inflation, which has been sticky for a while, and at the same time you're having central banks focus on their liquidity management. It's not just about inflation, it's also about controlling how much money there is floating around in the economy. So your context has changed drastically, which means your portfolio construction also has to change in a certain manner, because now the focus has shifted from low interest rates, low inflation and high liquidity to moderate inflation or high inflation and declining liquidity. So this can still have an impact on financial markets, and investors need to choose a different set of asset classes. The traditional 60/40 portfolio need not play out the way that you expected it to, and there is merit in holding cash because there is uncertainty in how portfolios will react to the new macro environment. There is also merit in looking at another set of asset classes. This could mean emerging equities, it could mean precious metals, it could mean commodities, it could mean a whole bunch of other things that investors have not considered in the past. So today, multi-asset investing can actually be very vibrant for a non-resident Indian investor living abroad. There are plenty of opportunities in India, there are plenty of opportunities in constructing your portfolio. And if you'd like to know more about how you can benefit from multi-asset investing, do get in touch with us.